Unfortunately, there's been some big changes in the 9 months since I first retired. The US economy has gone from the envy of the world to most of us feeling like we're either in a recession or we're very soon going to be in a recession. And inflation, which had been coming down, now because of tariffs, it looks like our costs for a lot of goods and services is going to go up. So, what does this mean? Do I have to quit retirement? Do I have to go back to work? And many of you that are thinking about retiring or have retired recently, you may be thinking the same thing. So I want to share my situation and my perspective. Hopefully it'll be helpful to folks, whether you've retired 5 months ago, you're 5 months from retirement, or you're 5 or more years from retirement. And the first thing to answer the question is no. Thankfully, I'm not going to have to go back to work. And I want to share why that is, because it can help all of us weather storms like we're going through now. And frankly, where we're at now is not that scary. I mean, yes, the future looks uncertain, but a stock market that went from being at all-time highs to being down 10%, as a retired financial planner, that doesn't surprise me. That was part of the base case. That was not a worst case scenario. For me, worst case scenario is the market being down 40, 50, 60%. And most of us are going to have at least some of our money in the stock market in order to maintain our purchasing power and in order to keep up with inflation. So for most of us, there is no choice. We're going to have some exposure to the stock market. And I do as well. I'm probably more conservatively invested than most people would think somebody like myself would be. I'm a big believer in stocks. I'm a big believer in equities. I'm a big believer that 10 years from now, 20 years from now, I'll be glad that I had at least some of my portfolio in stocks. But I also know the journey can be rough. It can be bumpy. And I don't want to have to worry about that. I don't want to have sleepless nights. I know that the price for that long-term performance in the stock market, the price of that is volatility. And too much volatility can really steal joy from our retirement. And one of the things I was fortunate, having worked as a financial advisor, is to see people on the journey before me and see people that successfully navigated difficult times. And one of the things that's key to navigating difficult times is understanding how we're going to feel about market volatility, how we're going to feel about our account being down $100,000, $200,000 or more. You know, when you're 40 years old, weathering that storm, weathering that challenge of having, your account down $100,000 or more, it's relatively easy because you still have 20 years of work in front of you. You still have income coming in that you can put into the market and buy in at low prices. But as we get older, as we walk away from that continuous river, delivering paychecks twice a month, as we get further from that stream, and it becomes harder and harder to go back to that if we were to ever want to, the pain of loss, unfortunately, becomes much higher. And it doesn't become 10 or 20% higher. For many of us, it's going to be 2, 3, 5 times as painful or more. So knowing that ahead of time and planning for that moment when we open up our account balance once a quarter and it's down $100,000 or more, it's just human nature to think, how long did it take me to save my first $100,000? And the reality is, if we're fortunate enough to be able to save $10,000 a year, and if we get 7% return on that in a mixed portfolio of stocks and bonds, it takes us about 8 years of saving $10,000 a year to save that first $100,000. So it's just human nature when you get your statement to say, I was 30 or I was 35 before I had my first $100,000. And that can leave a pit in your stomach. So how do we protect ourselves from that? The way we protect ourselves is job number one is knowing that it can happen, preparing mentally, and knowing that that can happen beforehand and planning accordingly. If you're likely to suffer angst, in other words, none of us like when the market is down 10%. First off, the market almost every year we're going to be down 5 or 10%. It is a feature of the market. It is more likely to happen than not. And so having, being able to withstand that hopefully is pretty straightforward. I say that everybody is a hero until their portfolio is down 30% or more. And that's when it gets tough. Or when their portfolio is down for 2 years, 3 years or more. One down year, a lot of us can weather that. But when it's 2 or 3 years, we start second guessing. Should I have portfolios? Maybe US stocks are never going to outperform again, right? We start thinking like that. And there have been periods where there is a lost decade. And frankly, you don't know if it's going to be a lost decade where stocks stay flat or don't get back to their previous heights for 10 years or more. We don't know whether we're in that at any given time. We only know that in hindsight. And of course, we have to invest 10 years of our life to get the wisdom from that hindsight. So better to think about it ahead of time. So having a good plan, taking no more risk than what you need to achieve your goals. And if you have to take too much risk in order to achieve your goals, you really have to second guess. You really have to ask yourself, is now really the right time to retire? Or would I be much better served to work a little bit longer so I don't have to take a level of risk that could expose me to something that I don't feel I could withstand? Because the worst case scenario is when the market's down and we become a forced seller because we need the cash, or because the worrying has gone to angst and we've now gone 3 days, 5 days, a week, 2 weeks where we can't sleep, and all day long we have this knot in our stomach. So think about that now, and do not put yourself in a situation where you're taking more risk than you can withstand, because you know what? Sometimes that works out, and maybe the majority of the time people are okay. But it's like picking up nickels and quarters on the train track. Unfortunately, sometimes the train does catch up to us. And I don't want that to happen to you. I want to see you succeed. Now, none of this is financial advice. I don't know your situation, but most of us are going to be best served by having an asset allocation that's the right match for us, that we don't need a lot of luck for things to work out. We don't want to rely on luck. We want to rely on, this is a prudent plan. This is a plan that other people with experience, other people with wisdom can look at, give you a second opinion on, and say, you know what, there's a high likelihood that this is going to succeed. What you don't want to hear is, boy, this is super risky. It may work out. And sometimes I hear that, from when I was still working as a financial advisor. Somebody would say, I only need this to work for 2 or 3 years, or, this stock was up 100% last year, and I only needed to do that 1 more year. Those words, I only needed to, should be a cautionary flag for all of us. And I don't want you to, I only need this to work for the next 6 months. I want you to have a plan that has a high likelihood of working over a long period of time without having to rely on a lot of luck for it to work. And if you like videos like this, that's about making good decisions, it's about thinking about how do you put yourself in a position to win, then the YouTube algorithm says, this is the next video of mine specifically for you that you should watch next. Thanks for watching this one. Bye-bye.